Hey everyone, thank you for tuning in to today's video. We got a lot of great feedback about the type of content people wanted to see. So in today's episode, we're going to talk about car loans. We're going to focus on the tricks and the tactics dealerships use to lock you into bad deals and give you the knowledge to avoid them. We won't be talking about leasing versus buying yet, but we'll get to that topic once this is explained. At some point in your life, you've probably thought about buying a car, whether it was for work or just to socialize. It's something that most of us have all come across. So what is a car loan? Well, a car loan is a loan that is secured against your vehicle. That means if you miss your car payments, then the lender can take possession of your car and sell it to recoup their money. Like a mortgage, the lender charges you interest for giving you the loan, and you have to make monthly payments on it. The loans are usually 3 to 5 years long, but we've seen in recent times that they've been increasing in length. Since car loans are relatively smaller and low risk because they're secured by the car, even if you have really bad credit, you'll still be able to get a car. Unfortunately though, the worse your credit is, the higher the interest rate is going to be on the loan. Most traditional lenders will charge you 4 to 10% interest if you have great to good credit, but it can be as high as 15-20% interest on your loan if you have bad credit. The cool thing about calculating a car payment is that it's the same formula that's used to calculate a mortgage payment. Again, it's way easier to use the online calculator, but I thought I'd point that out. Let's take an example. If I were to look at a 2020 Honda Civic with the basic options, it's about $25,000 before taxes. Say we finance the car. And by the way, all financing means is that you're buying the car and taking a loan on it. So let's say we're going to finance the car and we're going to put $0 down. So we're not putting a down payment on it. We're just going to borrow the full $25,000 plus tax. And for the sake of this example, let's say we get a 3% interest rate. Calculating all that out, your payment is about $507 a month. And over 5 years, you're going to pay $2,200 in interest. Let's say we decide to extend the terms out. So instead of financing it over 5 years, we decide that we're going to do it over 7, meaning we'll pay the car off in full in 7 years. If we finance over 7 years and keep everything the same, the interest rate the same, the price of the car the same, our monthly payment is then $373. And over the 7 years, you would have paid $3,100 in interest. As you can see, by extending the terms of the loan and making it longer, you're able to get a monthly payment that's a lot lower, but you end up paying almost $1,000 more in interest in just 2 years. This is the game that the lenders have been playing recently now, to advertise low monthly payments to entice buyers. It is really dangerous because the buyer ends up paying a lot more over time, but they don't realize it because they're just focused on those bite-sized payments. With the Honda Civic example, we only saw a difference of $1,000, but let me show you how this can be really problematic. Looking at a basic BMW 3 Series with minor upgrades, we're looking at $60,000 luxury car before taxes. Again, let's use the same parameters. We're going to finance over 5 years at a 3% loan. Our monthly payment on this BMW would be around $1,220. And over 5 years, we would pay $5,300 in interest. If we extended this loan out to 7 years, the monthly payment drops down to $896. And the interest we would pay over the 7 years is $7,450. As you can see, by extending the loan out 2 more years, the monthly payment drops by almost 36%. But you're paying $2,100 more in interest. Now imagine if the car was more expensive than that. You can see how the dealerships can convince someone that they can afford a more expensive car by selling them on the low monthly payments, but trap them into a long loan where they're paying a lot more interest. You may think at this point in the video, if I'm in a long-term loan, what does that matter? I'm driving the car I want and I'm enjoying it at a price that I can afford. The problem is in one word, and that's depreciation. Depreciation is the concept that the more you use something, the lower in value it goes. For example, the day you buy the car, it'll have no kilometers driven, no accidents, no scratches. It'll be the most valuable it's ever going to be. After the first year of driving, Most studies show that your car has already lost between 20 and 30% of its value. In fact, the common rule of thumb is that your car loses 60% of its value by year 5. Again, the loss of the value is coming from wear and tear of driving it, how many kilometers you've driven it, the fact that in 5 years tons of new models have come out with better features, and that older cars require more maintenance, which can be really expensive. Let's go back to the BMW example. The day that you bought it, it was worth $60,000 plus taxes and fees, so that's $68,000. In 5 years, the value of the car is about $27,000, but you're still going to be paying $896 a month on it for 2 more years. While some cars do hold their value better than others, the point is being highlighted that in year 1, you may feel like, hey, this $896 I'm paying, it's totally worth it. But by year 5, 6, and 7, you may feel like you're getting ripped off. This is a really common strategy dealership use to entice you to buy, because once you're locked into the loan, you're stuck. Focusing on payments is a good tactic to make people buy cars they normally wouldn't afford. A good way to combat this is to always negotiate with the total price of the car. The total price, not the payments. If you were able to lower the price of the BMW from $60,000 to $57,000 on a 5-year lease at 3%, so just like the example we had before, you would pay $1,157. So that works out to $61 less a month and almost $300 less in interest over the loan. So you can see you don't need to extend the loan to save money in the short run or the long term. You just need to try to negotiate the actual total price of the car down. To end off this video, I just want to talk about some budgeting tips and rule of thumbs that people use when buying a car. These are not absolute rules as everyone's situation is different, but these are some best practices that I found. Some experts say you should aim to spend around 10% of your take-home pay on a car. That means if you make $45,000 a year before taxes, you would aim to spend around $300 a month on your car payment. In terms of putting money down, a lot of people opt to put 10% down on a car to keep their loan amount lower so you pay less interest. Again, it depends on the situation if you have the funds or not. The other key thing is don't be afraid to buy a used car. They are cheaper and depending on the model can last for a really long time. It is important to do your research and make sure they've been maintained properly, but do not feel like you only need to purchase a brand new car. Well, that about wraps up today's episode. I hope that clears up any misconceptions about car loans and that now you know what to avoid at the dealerships and how to avoid being stuck in a bad loan that you are not happy with. Thanks for listening. Again, I just wanted to thank everybody for the support of the channel. Remember to like, comment, and subscribe, and have a nice day.